Bob Sechan, your neutral equities. Are you right, or is Tudor Jones right? Is it time to get long or be cautious?
I would tell you we're comfortable, but not complacent with where we are. We're not taking any big portfolio risk right now because we suspect volatility is going to come in the next few months as it relates to trade, as it relates to any headline that comes out. However, over the intermediate term, we're pretty comfortable. So what we've done is reposition risk within our equity category.
You say you're being comfortable. You're comfortable being cautious?
I am comfortable with the intermediate term, more cautious over the very short run.
Okay.
Now, that doesn't mean we're negative. I think what we've done is reposition a little bit. So we've moved out of our Eurozone exposure and into the U.S. for the quality purposes, and we maintain some long-term cyclicality in Japan and in emerging markets.
Okay. Weiss, you're cautious as well on the market.
Yeah.
And I'm wondering, look, he says it's not really that difficult. It's part of a standard playbook, which he calls first rate cut 101, which includes being long rates, gold, and at some point short the dollar. Fed's going to cut rates, he says. If that happens, stocks are going to go up. Period. End of story.
Right. So a couple things.
Makes sense?
It does in one respect, and I'll get there. So I had cut my exposure massively, added it back when the market started to turn on the Mexico news. Now we're back 2% in from the highs. And he's right. We've had 9 rate tightenings, 9 rate increases since the end of 2015. Here's where I disagree. There is no playbook 101 anymore, and there hasn't been for years. So while I could make a case for being bullish on the market and very bullish, there's one overarching consideration, and that's trade. So if you can tell me how trade gets resolved.
Which he doesn't ignore either, obviously,
right.
But that's one of the reasons that has sort of forced the hand of the Fed to begin this cycle.
Well, you got to buy into that also. You got to buy into that also. And as you may reference, and as we had in the notes, and I've read, not everybody's on board that the Fed's going to cut.
Well, that's the wild card.
Right. And
okay?
and right now, so there's complacency. There's complacency that a trade deal will get done. You won't see one done at G20. You may see better negotiations on it. And there's complacency that the Fed will cut rates not once, but twice, in some cases 3 times.
I think the market's offside, to your point. Sides on that right now. I do not think there's the information available to ascertain whether they're going to cut or not. I do think if you have some major agita coming out of the G20 as it relates to trade, the probabilities of that go up and the likelihood goes up.
You said the right word, Kristen, probabilities, right? You have to play the probabilities when you're making decisions on whether to invest now or not to.
Absolutely. And you have to look at the potential outcomes, right? So there's basically 3 outcomes that we have here. So it's trade and the Fed driving the markets. And if we look at the potential outcomes, we either have a deal at the G20, which would be a handshake deal, not a finalized deal, which would be positive for markets, or we have no deal, no Fed easing, which is actually where we're at right now. We are at no deal, no Fed easing, no certain Fed easing, or we get to a point where there's no deal and some cuts. But the market is behaving like we're already in that environment.
Well, it's trying to anticipate where we are.
But close to 100 basis points out to next year of cuts. That's pretty extreme, and that's supporting the markets right now.
So if I told y'all that, okay, I guarantee you that the Fed's going to cut at least 25 basis points in July, is Tudor Jones going to be right? Are stocks going to be up? Is now the time to buy stocks?
I think
we don't know that they're going to cut, but if I say they're definitely going to do it,
and
we begin to believe that they really are.
I would say over the next 3 to 6 months that, yes, stocks will be higher. Yeah, there's the unpredictability of what's going to happen with trade. I would think in those 3 to 6 months, you'll get something that looks like, okay, we're on the path to something. We're probably not going to get there by the election in November of 2020 because politically it's probably not the right thing to do. But the appearance to the market will be that there's something there. I would go back and say this. Paul was correct in December. Let's remember when he said in 19 there will be no further Fed raises. So they were not able to hike rates. Paul was correct about that. And I still believe a lot of this, Scott, is responding to the market. So in the last 48 hours, we have talked about, well, should the Fed cut rates? Why are we discussing that? Because the S&P is moving towards a new all-time high. Just on Friday, after that unemployment report, everyone was convinced, wait, That's the first bad unemployment number we've had in a while. The Fed needs to cut rates. Then this morning we got a bad inflation number, right? Well, there's the economic evidence. The Fed needs to raise rates. So it just seems to me we're responding to where the S&P is when we have this conversation.
It depends on context.
We didn't get a bad inflation number. What do you mean a bad inflation number? We got a no inflation number, which clears the decks for the Fed to make its move because it doesn't have to worry about it.
Right, in terms of what gas was telling us, and then in terms of what healthcare and rents and other prices that are rising. I think the one thing, though, going back to the probability, we always tend to look at these decisions that you either have to be fully invested or out of the market. And I think these markets actually create wonderful conditions for options. So if you look at volatility still remains pretty muted. If you want to play that there is a rally over the summer, you can buy cheap upside over the next 2 months to participate in that. If you want to play the opposite, that we could see a pullback due to light volumes in the summer months, due to the fact that we don't get the agreement that we're looking for in trade, then that's also a relatively easy way to stay invested but protected. You can hedge these outcomes right now, and the market gives us that opportunity.